Day trading or buy and hold. Many people wonder which strategy is right for them. Or maybe they have already made up their mind and are sure which one is better. Today, we want to dive into the topic, exploring which strategy fits who and how maybe even both strategies might be combined. More on that after the intro. Hello and welcome. My name is Henrik, and today we want to explore the different investment strategies. So let's first clarify the differences. Of course, the primary distinction is the duration of the investment. Day trading involves short periods, sometimes even within minutes or hours, whereas buy and hold targets the longer time frames, potentially even spanning decades, especially when it comes to retirement planning. Beyond that, while it's not a strict rule, different types of assets are often invested in within each strategy. A day trader tends to trade individual stocks or maybe even cryptocurrencies, whereas a buy and hold investor often turns to stock indices such as the S&P 500 or the MSCI World. This is because day traders actively seek volatility, as quick profits rely on market fluctuations, while buy and hold investors focus on secure investments that grow steadily over time. But there is also a third alternative, swing trading, a hybrid approach that involves medium-term investments ranging from weeks to months, aiming to profit from the general market trends. But now comes the question, which method is best? Or rather, which method is best for who? Day trading has clear advantages. This method offers the highest potential for profits, but unfortunately also for losses. A skilled day trader can achieve gains that are simply unthinkable with a buy and hold strategy. Instead of aiming for 10% annually, one might make 10% a month or maybe even more. However, there comes a big caveat. The average day trader is actually losing money. That is because day trading requires extensive knowledge of the financial market and a significant amount of time investment. So those who truly want to commit to the financial market and make trading their profession, they can be very successful with it. But for those who are only looking to casually try it out, it's easy to take a financial hit, so it's best to stay away. It becomes especially dangerous when people think they know what they're doing, but actually don't. In such cases, it's essential to find a mentor to learn from. But now let's look at the alternative, buy and hold. Buy and hold is, of course, very simple. You just need to do one thing, buy. However, this approach also has its challenges. It requires a lot of mental strength, because over the years and decades, investors will likely experience several economic downfalls and crises, and must endure them without withdrawing their money at market lows, something that a lot of investors tend to do. To make it a bit more clear, let's take a look here at the S&P 500 index. And then we can see several phases here. So for example, from the top here in 1929, it took until 1954 to reach the same level. Similarly here, it took from 68 to 80 to reach the same level. And it took from 2000 to 2013 to reach the same level. So you can see clearly that oftentimes here in this market structure, it took 10 to maybe even 20 years to reach the previous level. So if you're lucky and you enter in a bullish phase like this, then you can rake in a lot of gains. But if you enter in a phase like this, you might sit there after 10 or 20 years with nothing to show for it. But nonetheless, investing in ETFs using a buy and hold strategy can generate relatively safe returns. So for those who have no interest in actively engaging with the financial market, it may be a better option than simply letting money sit in a bank account. However, there is room for optimization, especially if you consider one aspect, and that is that the MSCI World Index that most people use for the buy and hold strategy is actually not as diversified as it used to be. That is because the US stocks, mainly the big technological companies, have grown so much in the past few decades that now they make up a total of 71% of the index, while other countries barely make a couple percent. And 23% are locked up only in these 10 companies, which are mostly these big tech companies from the US. So if the US economy were to decline, which recent political developments suggest as a possibility, this could pose some risk. So maybe it would be wise to invest in some other indices around the world to diversify your portfolio a bit more. But finally, let's discuss the last alternative, which is swing trading. This is probably the best method for most people. It allows for better entry points, and the goal here is not necessarily to perfectly time every high and low in the market, because almost no one is going to be able to do that. However, a slightly more strategic approach to investing can generate additional percentage gains annually compared to the buy and hold strategy, which will add up over time. Now, this can take different forms. So, for example, one could invest in sector indices, and when one sector outperforms, just shift money from one to another. Alternatively, if the market overheats, holding back some cash to reinvest after correction might be beneficial. Swing traders also can selectively invest in promising individual stocks, such as over here in Germany with the company Rheinmetall. And while it may not have been so easy to capture the full, almost 4,000% gain that happened, if you were just a bit informed about how things were going, you could have easily raked in 100, 200, maybe even 300%, and then gotten out as things got too hot. Now, of course, with this strategy, a lot of mistakes can be made as well. So it's essential to stay at least slightly informed, or better yet, find a trusted financial partner. And most importantly, if you do so, it's important to evaluate whether this approach even makes financial sense. For instance, if you do want to find a financial information service, which might cost you something like $50 a month, which would be $600 a year, which might help you to increase your gains from the 10% which you're likely to get from the MSCI World to maybe 15% a year, then the additional 5% must be worth at least these $600. So this means your portfolio should have a minimum size of around $12,000. Otherwise, it's best to save up until this strategy is truly viable. So to summarize, those who want to make trading their full-time focus can pursue day trading, but those who want minimal involvement can opt for a buy and hold strategy rather than letting their money sit idle. For everyone else, swing trading is likely the best choice. So if you'd like more information or advice, feel free to get in touch with us, and we'd also appreciate a like or subscription from everyone. With that, have a great week and see you next time here at Bloomberg Capital.